Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Dearborn and Max Cabasso, managing directors on the Nasdaq Market Intelligence Desk, as well as Sarbjit Nahal, portfolio manager at Lazard Asset Management, focusing on equity megatrends. We're here to discuss active management and global megatrends that will shape the future economy. It is great to have all of you with us. Welcome to Trade Talks. Speaking of active management, there certainly has been a number of plays in the market as 2025 has turned out to be a little bit more volatile than expected.
Definitely, but it's all the more reason for active management. It's one of the core reasons that Lazard Asset Management has launched this suite of actively managed ETFs, and that includes us. We have a product called Lazard Equity Megatrends. It's focused on long-term capital appreciation via an active portfolio of global companies, and our key differentiator is our focus on megatrends, the big structural drivers that are going to be changing the economy and society over the course of the next 10 years, so we're long-term oriented, and we do that by anchoring our portfolio to long-term themes which we think are poised to benefit from these structural changes.
What's an example of one of those themes?
Yeah, I can give you one example is what we're seeing in the software space. So you'll be very familiar with what's been happening with the cloud, and that's obviously still a growth market. We think it's going to grow to about 3.4 trillion by 2040. But what we're incredibly excited about is the software apps and agents, which are both assisting humans and which are going to be augmenting and eventually replacing humans. And there's some incredible stuff that's happening. These agents are obviously capable of independently performing complex tasks with minimal or no human intervention. And we're reaching the sort of stage now where you want to book a holiday. Let's say you're going to Montreal. Your agent is going to be able to liaise with the airline, get you your favorite seat in 1A. It knows that you like jazz. It's going to get you tickets for the jazz festival. It knows that you like women's tennis. It's going to get you tickets for the women's festival. It's going to get you your favorite room on the top floor of the hotel and then book you an Uber Black on the way back. That's just what's happening on a personal level. But from a company perspective, this has the potential to be as transformative as the steam engine was in the industrial era, and it's going to impact every single element of company workflow, from research and development through to production, through to distribution, marketing, and service. And by 2028, we're estimating that about 15% of daily business activity could be conducted by these agents. Looking a little bit further out, by the mid-2030s, we could be looking at 15 billion agents, so twice the global population. And in terms of the market opportunity, we think this could grow to become a $4.6 trillion opportunity by 2040. So exciting stuff.
It really is. And Chris, what's so interesting, you could, when we're going through the dot-com boom, and of course the silver lining is the opportunity that comes out of, these 10, 15-year cycles that we go through. Think about companies such as Meta, which got listed after the dot-com boom, Tesla, and others. Just because there's volatility in the market doesn't mean that these opportunities don't exist longer term.
Right. The pace for a lot of these companies as they come through, you're really not unsure of which one's going to succeed and which one's going to fail, or which ones are going to combine to make a better company. And you saw that through the dot-com bubble. We lived it trading back then in 2000. We saw it come through again, and it's kind of thematic throughout the cycle, throughout history. You want innovation, companies that innovate, you want to buy that multiple forward for them, and you want to see how they can grow it. So when you look at a lot of the dot-com companies from like 2000, 2005, when we went through that phase where anything, shoeshine.com, we're buying it, and it came back down, the better survivors with good products are the ones that came through. And now you have that same thematic thing, right?
I totally agree with you, and it's a fundamental part of everything we do. We're trying to build a bottoms-up picture of the world. So, we meet with 4,500 companies every single year, and we're asking them, where are you allocating CapEx today that the market is underappreciating, but that you think is going to pay significant dividends in 3 to 5 years? As a Canadian, I'll use the hockey analogy, and it's all about skating to where the puck is going to be rather than where it's been. And we've got to be able to weather these short-term cycles because there's huge opportunities off the back of these long-term megatrends.
Yeah, there certainly is. I'm sorry, Chris, and one second on that. But Max, if we think about it from this perspective, there has not been that much of a cutback in CapEx for 2025. In fact, I believe it was higher than it was last year. And that's one of the areas in the market, regardless of the volatility, that's what sets it up for future growth.
For sure. I think the setup is constructive in the sense companies were in a better place going into this. They were well funded. They had the capital. They were planning on deploying that capital, and also the rate environment. Obviously, we would love a rate cut, but we're not in a zero rate environment now where anybody and everybody can just go out and borrow money. There needs to be a return. So those companies that were in a healthier position, I don't think we're going to see as much of that kind of frothy bubble where everybody is able to pile into this because you have cheap money and there's zero interest rates. So there's not just going to be this frenzy into it. It's the companies that have that long-term vision, that had the capital, that can go out and deploy it, and then have the agents kind of build into the system and have other developers get involved in the software. But the companies that are deploying this capital are well capitalized. They have the funds there, so they can go out and deploy it and have that vision of 5-10 years. We're not looking 1 year, what is this CapEx going to do to us here? It's, okay, we're building this out for the long term. We're ready to go, and we're not in a position where we're troubled, we're distressed, we need to raise capital here in this environment. They're capitalized, they're ready to deploy it, and they're looking at in that long term.
Right.
I would reiterate that's exactly what many company CEOs are telling us, is that we're entering a new era in terms of CapEx. You look at the structural drivers from globalization to reshoring to national security, and you look at what's happening on the ground here in markets like the US from February 23 to February 24. We saw $225 billion in private investment in new manufacturing facilities. You look at what's happening in the semiconductor space, and 18 months from December 24 to December 23 to August 24, we saw $450 billion worth of investments being committed to redeveloping capacity here in the US, which could see the US's share of advanced semis rise from 9% to 28% of global production. So huge opportunities in terms of not only automation, spaces like industrial robots, we're up to 4.3 million robots operating in factories around the world, but that shift that we're seeing in factories where it's not just about hardware anymore, it's about software, it's about being connected at the edge, it's artificial intelligence, all under one operating system. We could equate it to something like a smartphone with robotic arms, and you think about digitalization and AI in the manufacturing space, $500 billion market today, that's going to grow to $1.5 trillion over the course of the next 5 years.
And Chris, Max put up a great point too, and think about what companies have been through in the past 5 years alone. You had that, migration to cloud, number one, then we get hit with COVID, a couple of elections in between. We had some, the volatility in 21 and 22, and to Max's point, some of them have operated quite well, where it's not so contingent on, I need that, interest rate cut, 1, 2, cuts just so that I can make my balance sheet look better. These are good companies.
If you're committed to your business model and you have faith in what you're doing and you have an end goal to where you can get, most companies will find a way to succeed. The capital part of it is what is the fluctuation. If you're a smaller company, especially if you're a small cap or a mid cap company, and you need to borrow money for continued operations, it's gotten very, very expensive lately, right? If you're a larger company, you can bellwether those type of fluctuations because you have positive cash flow coming in from different areas. Amazon's a prime example of that, right? When you look at Microsoft as well and any of the larger cap companies, but when you look at what's actually needed, it changes quite often as the business develops. When you look at the securities part of it, right? You're looking at companies like Palantir who have been cash negative, cash burn, reinvesting into their business, and now are finally starting to be cash flow positive, taking some of those profits out, and they're finally getting them forward multiple. Granted, it's a high multiple, but that's going to work out. Cloudflare and a couple of the others are very similar examples. The business is going to continue to evolve for those who understand what they need to do and where they need to grow. If they have the vision to see 5 to 10 years down the road, take out the old Mao Zedong plans, what's my 5-year plan, right? And a lot of companies don't always have that. And the 5-year plans change for a lot of the small companies because they don't have the capital to continue to grow, which means they either have to find a partner or they go by the wayside.
Yeah, well, and also in the span of 5 years, with technology emerging as quickly as it is, that 5-year plan could, it could be accelerated, and it could be the 2-3-year plan. Right?
Totally, but once again, it all comes down to the benefits of that longer-term thinking about those structural factors that are impacting the markets. And it's also important, for us as an asset management firm, when we're dealing with our clients. There's $562 billion in assets under management that are invested thematically. Younger investors are thinking longer term. Over 40% of millennial and Generation Z investors already invest thematically, taking into account these longer term issues. And when we look forward, we're going to see $120 trillion shifting intergenerationally over the course of the next 25 years. And the reality is that for financial advisors, only 13% of their clients stick with their FA when the money changes hands. So once again, it comes down to integrating this long-term thinking, whether you're the CEO of a corporate, whether you're the CEO of an asset manager, or whether you're a financial advisor.
Which is interesting because if you remove the financial advisor end of it, but any company, the demographics are going to be, your strategy is going to be contingent on those demographics, for sure.
Definitely, it's one of the key structural drivers that we're seeing around the world.
So, Max, on the intelligence desk, you guys are talking to the Nasdaq issuers, our Nasdaq-listed companies, all day long. How are they interpreting short-term volatility and thinking beyond it longer term?
So the questions we've been getting more are kind of more around earnings, and we talked about it a few weeks ago about guidance, but they're almost looking for guidance on their guidance of what are people saying with their guidance? Are they going more status quo and keeping it how they normally would, or are you not providing guidance for the full year, or widening it out because there's still so much uncertainty? I think companies are still constructive on the outlook for their individual companies, but setting the tone for the year, for the market, they're being a bit more conservative, I think, because we've seen so much downward pressure outside of staples and utilities, but the defensive names, but tech and discretionary names have really gotten punished. So we've seen so much of that pressure already. Taking guidance down and being conservative with it, you're probably not going to get punished as much because of what's already come through, and it's just that uncertainty. So there's been just, again, more questions of what are other people saying at this point that have printed so far? What are we trying to fit? We're not trying to fit through the needle here at the end of the eye of the needle. Give a wider range if we need to, and we can adjust as we go along. But there's still so many questions that are unanswered. Whether it's a headline, this morning, yesterday, it is constantly changing. So I think there's focusing on the long term, essentially, and how to operate. But in the short term with guidance and earnings, it's, hey, let's be a little more conservative here and give a broader range than we might.
Yeah, Chris, I wonder if they're going to do if and when scenarios. So worst case,
a couple
best
have.
Case.
A couple of companies have. You had a major airline come out with two different alternatives. One if tariffs stay where they are as guidance, and one if they revert back to where they were. So they're unsure because the frenetic pace of what's coming through here with these headlines one day to the next. Look at today's market, it rallied significantly. Yesterday was okay, Monday we sold off big. Remember, Europe was closed Monday, but that was on the media headlines that Trump was looking to replace Powell, and he comes out last night saying that's not true, plus the ratcheting back of China. Again, his mentality is shoot the bazooka, see where the pieces land, and then let's get what we're going in. At the end game, when you look at the different companies, the shareholders are the ones that are suffering the most, and companies are uncertain how to forecast when they have an uncertain environment around global trade policy being directed out of Washington, D.C. Once that gets settled, things will probably be, but is there damage done? Absolutely.
Right.
If you look at the different data points, sentiment surveys are all very negative across the board. CEO, University of Michigan, but the data looking back with the hard data is pretty solid. Right? CPI is coming down, PPI is coming down, unemployment's at 4.2%, wages are a little bit lighter at 3.8% from last month, but still pretty good. Not necessarily keeping pace with inflation over the last 5 years, but doing better than what inflation's doing right now. And the unemployment rate at 4.2% isn't elevated. It is not. And the question then comes down to how do companies forecast that? You can't. I read it the other day, and I remember this from a while, way back when. Is about 40% of the companies in the S&P 500 give forward guidance. And those companies generally do about 10% better than other companies that do not on a quarter-over-quarter basis because analysts and investors can benchmark to those investments and how they're engaging. Companies are dialing that back. We're going to see, we're very early into earnings season right now, only about 20% of the S&P 500 reported, most of them on the bank side, a few on the industrials. And when you have Delta giving you an alternate scenario, right, you don't know what's going to happen. The discretionary ones is going to be very interesting. That comes up later in the cycle. We got about a few weeks before we get to see the meat of what's actually happening there.
And I would just add that it's one of the advantages of taking this long-term sort of approach that we try to do with megatrends and themes is that these times of tumult can create opportunities. For us, there's no better opportunity than buying a solid structural story at a moment of cyclical weakness. So you look at some of our themes, I was talking earlier about smart CapEx, the same for our future of healthcare sort of theme. The underlying structural and secular thematic drivers are not going away on these stories, and if you're willing to get in early, there's going to be significant return opportunities over the long term.
Agree 100%.
And as you think longer term, do you think the damage has been done? We'll see different trade alliances and different economies align in a different way, or is it too early to tell, or does it even matter as it relates to your thesis?
Well, look, there's definitely a rejigging taking place. This is not the sort of stuff that we can ignore, but we have to be cognizant of the fact that this is not just something that's been happening overnight.
Right.
This has been taking place over years and years, that companies have been trying to bring back manufacturing to their home base, whether it's in Europe, whether it's in Canada, whether it's in the United States. The opportunity that arises today is that technology, as you know very well, is making this a realistic possibility.
Yeah, because at the end of the day, we were diversifying supply chains because of what we learned during COVID and the supply chain crisis we experienced then. So we were diversifying it for all intents and purposes. You saw that migration away from China and looking to get to other areas.
Totally, and there's still massive low-hanging fruits that exist within this space. You look around the world and only 20 to 30% of manufacturing facilities are automated. Only 20% of buildings use automation technologies. This is base level stuff, so massive room for growth. I talked about robots earlier, but if you think about industrial robots, America would have to grow its stock of robots by a factor of 3.5 times if they were to reach the sort of per capita rates of penetration that we see in markets like South Korea.
Yeah, and it's a great example because, Max, the rest of the world and technology itself is not going to slow down.
No.
Just because there's uncertainty.
Yeah, I mean, that's been our chief export, has been technology. Trade wars or not, technology is going to progress. I mean, we've seen it with AI. It was, last year it was, it's just a hype cycle, and then it's like, well, wait a second, this is really coming. The train's already down that tracks, it's going. You're not just going to be able to stop it because we want to. So it's at a point now of keeping up. Everybody else is going to be doing it as well. So as much as we want to bring everything back and onshore, like you said, South Korea, Asia, they're going to be continuing to advance and use these new technologies. So those efficiencies will come to the U.S. whether we like it or not.
Yeah.
Like, it's going to happen.
Well, I mean, AI and ML, it's nothing new. I mean, we've been using it in finance for years.
Years.
Yes.
Exactly.
Just different names, right? It's all different names.
Well, I think, with the Gen AI becoming part of the consumer vernacular, that was the catalyst. I mean, it makes you wonder, without that in November 2022, that story coming out, perhaps our multiples would not have been so high in the market because it was reflective everywhere.
It was.
And I would add, I think the big game changer in terms of AI is that we're finally starting to see practical, tangible applications of AI and a solid return on investment. So I talked earlier about those software agents that are increasingly taking over the world. They are 80 to 90% cheaper than using a human employee.
Yeah.
You look at the quote-unquote deflection rate. These agents are able to deal with anywhere from 95 to 100% of problems that arise from a customer perspective without human intervention.
Right.
So that whole idea of return on investment in terms of these massive investments that have been made over the course of the last 5 to 10 years is finally starting to become a reality, and that we believe is a game changer.
Yeah.
The applications of these technologies.
And Chris, I want to give you the last word here. I mean, there's going to, from a compliance perspective, you do have to have a human in the loop. But when you think about it, more circular economy, retraining and reskilling the workforce for the right kinds of jobs to move us forward and be number one in innovation, those are great paying salary jobs. And that only gets back into the economy if you want to think, longer term what this means.
Right. We've gone through this cycle multiple times with different items. Think of what happened during the housing bubble, the financial crisis, a lot of other, and people have to relearn their skills. And that does move to growth, whether you go back to school, whether you get trained in other items. It's happened multiple times. I think that what we're going to see here over the next, probably take about 8 to 10 years to probably work its way through. And when it does, you're going to have a whole new generation of people behind us that are going to be completely skilled in different items than what we do today. And with that, it's going to be a better world for
And we'll
everyone
leave
else.
it on a positive note, guys. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.